My name is Manny Gomes, and I'm a certified mortgage planner with Norcom Mortgage. One of the questions I'm often asked is, now the time to buy a home? I put together a short presentation with historical references pertaining to both the housing and interest rate market to help you make your determination as to is now the right time to buy a home. And the first slide I have here is a chart showing the history of interest rates dating back to 1790. And one thing that should jump out to you is now rates are actually lower than they were back in the 1700s, and our forefathers had to borrow money at a higher cost than we're able to today. And taking that into perspective, that just really illustrates and highlights how low interest rates are today. And if you see these lines here that are drawn, they pretty much show a major bear market in the bond markets, followed by one of the greatest bull markets in bonds. And now there's really no other place for rates to go. They pretty much already hit rock bottom. We've never hit these lows in rates back in history. So it's safe to assume that the next kind of trend in rates would be for them to either head back up or stay sideways for a period of time. This chart shows the relationship between interest rates and home prices dating back to 1880. It's common knowledge that people believe when rates go up, home prices go down because the cost to own the home is much higher when rates increase. And this chart illustrates that that is not necessarily true. There's only been a couple periods in the past 100 or so years where interest rates and home prices have increased, and that was really post World War II as the economy started to improve. A byproduct of an improving economy is increasing interest rates. Also at this period, there was a lot of housing development and home prices were going up because there was a lot of demand for housing. Today, we have been enjoying a period where home rates have been dropping and home prices have been dropping, and it appears that we've broken the norm. There's always periods where home prices and interest rates kind of converge. Happened here, right before right before the Great Depression, into the 70s, again in the 80s, in the 2000s, and I have a good feeling that we're going to see interest rates and home prices meet again in terms of how they relate to one another. So the million-dollar question is really, where are rates headed? And before we answer that question, we really have to answer the question, why are they this low? Interest rates are at their levels due to Fed action. The Feds have been buying over $85 billion worth of mortgage-backed securities and U.S. Treasuries each month since about 2011. Their buying power has changed up a little bit since 2011, but they've been buying massive amounts of mortgage-backed securities and treasuries, and they have actually artificially held down interest rates. But now we're at a point where some of the economic data is showing proof that they should not be buying these bonds in such high quantities. And obviously this is going to impact rates. If the Fed stop buying these bonds, stop supporting the bond market, conventional wisdom tells us rates will increase. And that conventional wisdom was shown true back in May when Ben Bernanke in a statement stated that the Feds are considering tapering or reducing the amount of bonds they're buying each month. And immediately rates shot up about 1 percentage point. This chart here shows the 4% Fannie Mae coupon bond. The higher the price goes, the lower interest rates on 30-year fixed mortgages go. As you can see, right here, this day, Ben Bernanke made that statement. We saw bonds pricing erode by about 700 basis points, causing over a 1% increase in rates. At this point here, rates were right around the 3.5% mark. We got all the way near 5% before the September Fed meeting when they decided not to taper that meeting. The Wall Street was expecting them to start reducing the pace of mortgage-backed security purchases. And obviously, if a hedge fund trader or even yourself, if you believed that the asset you owned was going to come down in price and in a hurry, you would probably try selling it before you lose money. And this is exactly what Wall Street was trying to do. They're trying to get rid of their position of bonds ahead of the reduction from the Feds, because they know that as soon as the Feds reduce the purchase, the supply and demand is going to change, and people are going to want more yield in order to hold on to a bond, which means rates go up. This chart here shows home affordability, and home affordability is directly linked to interest rates. What housing affordability takes into consideration would be the rate of inflation, the cost of the home, and the cost to acquire the home monthly, so your monthly mortgage payment. We have been way past the mean for quite a while now in terms of housing affordability, ever since the housing collapse of 2008. We will, as rates go up and home prices go up, the affordability of a home decreases, because now you're paying more for the house and it's costing you more to own the home in terms of a monthly payment. So the housing affordability will decrease. We're at the highest housing affordability since these records have been kept. This chart here dates back to, excuse me, about 1980, and today we're at 2013, and we're at the highest level in housing affordability we've ever seen. So the housing affordability cannot stay this high for this long, especially if there's going to be a change in market sentiment, such as interest rates increasing or home prices increasing. So this just shows that right now is the good time to purchase something from a housing affordability perspective. Now, what is going to change things? What would be the three things that the Feds are looking at in order to reduce mortgage-backed securities? And I call it the big three. You know, I'm not talking about the automakers. I'm talking about jobs reports, our gross domestic product, the overall growth of the economy, and the Fed funds rate. Jobs reports, especially the one this past October, was much stronger than expected. And while we all know the jobs picture out there is not too robust, it has been picking up and it has been improving. Also, our GDP number, which just measures the growth of the economy, came in at 2.8, which was much stronger than expected. The Feds normally want to keep the GDP number right around 2%. So that's where they like it to be. And right now we're slightly above it. And the Fed funds rate, this is really just the borrowing cost for banks. So if the borrowing cost for banks is low, they could then lend to consumers at a lower rate, such as, and this really only pertains to, small business loans, credit cards, and other revolving loans. As the Fed funds rate increases, those rates increase. I truly believe the Fed funds rate is going to remain pegged at 0 or near 0 for the next 2 to 3 years, which will allow companies, as they see the economy improving, to borrow at very low cost of capital in order to grow and expand their operations. As this happens, jobs will improve. If a company has held off on expanding their operations due to economic uncertainty, and then they sense some uncertainty due to our economy growing and these economic numbers coming out more favorably month over month, they're going to start expanding, because a lot of companies have been holding on to cash and they've just been trying to be as profitable as possible as they can be, and waiting for the economy to turn around before they expand. So if the Fed funds rate stays near low while the Feds try to make sure the economy has a little bit of steam before they kind of get off the gas, we're going to see things improve much faster than most people believe. And what will the future hold? I don't have a crystal ball, and all I could really do is read these charts and interpret things from a macroeconomic standpoint as best as possible. But home prices have likely bottomed out. We've been seeing housing data come in much more favorably month over month. Home prices across the nation have really started to increase. We're in Connecticut right now. We're a judicial state. It takes a little bit longer in a judicial state to file a foreclosure and to go through the short sale process due to the legalities which are involved. So we're about a year to 18 months behind the rest of the country, or at least those states where they'd have a much quicker process to foreclose on a home. So while the rest of the country in the year 2013 has seen already probably 8 to 9% appreciation in real estate values, we here have not seen that at that level. We're closer to 2 to 3%, possibly 5%, depending on the town. I think that's all going to change for us in 2014 because the inventory levels of homes have dramatically decreased because there really is not as much activity in foreclosed or short sale homes out in the market. So as we return more to a normal market where there's an actual seller who wants to sell their home for a certain price and not a bank who just wants to get rid of the property and get it off their balance sheets, we will see home prices improve in this area and in Connecticut more so, while the other parts of the country will see smaller growth rates in terms of housing prices. But the reality is we will return to the historical norm, which is about 3 to 5% year over year. Home loan rates have also bottomed out. You know, the lowest they've really hit on a 30-year fix has been right around 3%. They're currently right around 4.25%. Some on any given day, maybe 4%. And unless we go back into a recessionary state in this country and the economic data that comes out is really unfavorable, rates probably are going to stay at this level, if not slowly increased. Sorry about that. And that's just the reality of it. The rates now stay low forever. There's cost to having really cheap capital out there for a long period of time. And the feds know that. They're not going to leave rates out there at these extreme low levels for a long period of time, because all that does is create future inflation problems. And that's the one thing that feds do not want to create, is inflation in this country. So again, my name is Manny Gomes. I can be reached at 203-673-2131, or you can email me at manny@mannymortgage.com, and I'll be happy to answer any questions you have or even have a conversation about this presentation. I hope you enjoyed that, and thank you very much.